Now let's have a look at margin. Margin is gross profit shown as the percentage of the selling price, not the cost price. So if we were to write this in an equation, we would say margin is equal to gross profit over selling price. So when you hear the word margin, you think of the selling price, which is referred to as sales. Also, this formula can be modified in order to find the gross profit. So what you can do is you can modify this formula to say gross profit is equal to selling price multiplied by the margin, or gross profit is equal to sales multiplied by the margin. In our example, we have Muswell Suppliers. Muswell Suppliers is a trading company owned by P. Muswell. Some of the business records were misplaced, but the owner was able to trace the following. Inventory as at 1 February 2018 was 13,500. Inventory at 31 January 2019 was 18,700. Sales was $104,000, and Muswell Suppliers applied a uniform margin of 25%. So here we need to focus on our sales and our margin. We need to calculate the following figures for Muswell Suppliers for the year ended 31 January 2019. We need to calculate the gross profit, the cost of sales, and the purchases. And again, gross profit, cost of sales, and purchases, it's best to calculate them using the trading account. So this is what the trading account looks like with the missing figures. So what we'll try to calculate first is the gross profit. So we will say sales multiplied by the margin, that will give us our gross profit. We have the sales, that's 104,000, multiplied the margin that was given, 25%, and that will give us a gross profit of 26,000. So we can enter that in our gross profit. Next, we'll have a look at our cost of sales. So we can say 104,000 less what is equal to 26,000, because sales less cost of sales will give us our gross profit. And we can rearrange this formula. We can say 104,000 less 26,000. That will give us 78,000, which is our cost of sales. The next amount we can calculate is our total that we would get from adding our opening inventory and our purchases. Now how would we go about doing this? We would say cost of sales, which is 78,000, plus our 18,700, which is our closing inventory, and that would give us the amount. And then we can work out our purchases. And by now this one should be straightforward. All we need to do is say the total less our opening inventory of 13,500, and that will give us our purchases of 83,200. And again, just like we did with Kamati stores, you calculate your gross profit first and then you work your way backwards.